Hey, what's up, guys? Welcome back to the Flex Free Game YouTube channel. Always good to have you guys back. Now, are you looking to make some consistent income in stocks without having to constantly watch the market, especially when the market has been as ugly as it's been over the last few weeks here or so? Now, today I want to talk about a strategy called cover calls. It might be the perfect strategy for you if you're looking to generate some income. You're looking for a little bit of a hedging strategy, especially in when the market is in a little bit of a pullback mode like we've been in recently. So cover calls allow you to generate income from stocks that you already own in your account and help you maximize profits while reducing risk. Again, we're looking to generate a little bit of a hedge while the market is kind of going down and looking to find some stable footing and get back in that upward direction. We want to have some strategies that are solid that allow us to bring in some consistent income into our account, and cover calls is going to do exactly that. So in this video, I'm going to break down cover calls. I'm going to talk about how they work, real simple steps. I'm going to give you my top strategy, my top steps, simple steps you can follow in this current market in all of 2025 to generate income consistently, weekly, monthly in your account through cover calls. You got to learn this strategy if you're looking for a simple income generating strategy. Now, first of all, let's talk about what is a cover call. Now, a cover call is an option strategy where you can sell a call option against stocks that you already own in your account. Now, how this works is you do have to have at least 100 shares of a stock in order to be able to do this strategy. So you have to have increments of 100 shares. If you have multiple increments of 100 shares, then you can sell more calls against those shares and bring in some more income. Now, you can also sell a call option. Once you have those 100 shares, you can sell a call option at a higher strike price than your actual cost basis of those shares, and you can collect premium for that just from selling the call. If the stock stays below the strike price of the call you sold, you get to keep the shares and you get to keep the premium. The most important thing is you're generating income. And if the stock rises above that strike price of the stock price of the call that you sold, then your shares get sold off from you, and you at a profit, right? You're selling higher than your current cost basis, and not only that, you still keep the premium. So again, this is a win-win strategy, one of my favorite strategies in the market, because you're going to be able to make some easy, simple, passive income in your account, and also you're giving yourself to make some potential gains as well, because you're selling your stock at a higher price than what you bought it for. So again, win-win strategy, right? Now, how do cover calls work? My top steps, simple steps for cover calls in 2025 and beyond, really. Step number one is you got to choose the right stock, right? It all begins there. I recommend starting with your blue chip stocks, your stable stocks that pay dividends. Now, I recommend, especially for people that are new to the market, sticking with stocks in the S&P 500. There's 500 stocks in there to choose from, so there's plenty of stocks to choose from in there. But those are going to be your top 500 stocks in the market, U.S. Stocks in the market. And I recommend starting there if you're looking to find some good stocks, right? You're going to have your Walmarts, your Amazons, your Nvidias in there, plenty of good companies to choose from, right? Now, if you're new to cover call writing, I also recommend that you avoid doing this strategy on high volatility, high growth stocks, because those stocks are going to be all over the place, right? They're going to be a roller coaster ride. Now, the premiums when you're selling the calls, they're going to be a lot bigger. So they're going to be a lot more tempting to trade those type of stocks and bring in more income. But if you don't want your account value to fluctuate a lot and the stocks to have these high volatility moves, then stick with those blue chip companies, your more stable companies. They're going to move a little slower. It's going to be a little more boring, but sometimes boring is good in the market. And most importantly, you're going to be making and generate some guaranteed income while things are just boring, right? While you're just chilling. So that's step number one. You got to pick the right stocks. Step number two, you got to pick the right strike price, right? Now, when it comes to picking a strike price, some people like to just use percentages of a stock. Some people will sell calls maybe at a 5 to 10% above the current price of their stock that they bought. They're kind of looking for a good balance of profit and premiums. Me personally, I like to sell just out of the money calls, depending on what my stock is doing and where things are in the market. But I'm just selling out of the money calls. I'm looking to generate some higher premiums, and closer you get to end the money, those premiums are going to get a little higher in that guaranteed money. But nothing wrong with going a little further out of the money if you want to give yourself a chance to generate some additional capital gains on those shares. So, for example, if you bought a stock, your cost basis is $100 a share. If you want to go out of the money, you would be selling your stock price or selling your call strike price at a higher price, let's say $105 strike price or higher, right? That's going to give yourself the chance to collect those additional capital gains on your shares right there. After you choose the right strike price, then you just need to choose your expiration date, right? Going out at least or up to 30 to 45 days. I typically don't go too much past 30 to 45 days, depending on what the market is doing and where my stock is at that price. It's got to be a little bit of a sweet spot for premium versus risk. But me personally, I do prefer shorter expiration days. It's going to offer a little more flexibility when it comes to selling your calls. And not only that, you're going to be able to bring in more income more frequently. Here in the Flex program, we call Monday Money Monday, right? Every single Monday, we're selling calls, we're generating income. So we look forward to Mondays while other people are dreading going to work. Monday is one of our favorite days of the trading week because that is a day that we're bringing in guaranteed predictable income in our account weekly, and we love that every single week. So I do prefer those shorter expiration days, but at times when the market is in a pullback like we are now, I will utilize longer dated calls and go up to about 30 to 45 days out, depending on if I need to or not. And then lastly, step 4, once we sell those calls, we need to manage our trade, right? If the stock price stays below the strike price that we choose, we get to keep the shares and we get to keep the guaranteed premium in our account, and we get to rinse repeat. Since we still have those shares, what can we do the following week? We can go right back into our account and sell another round of calls and bring in more income to our account on what? Money Monday, right? Now, scenario number 2, if the stock price rises above that strike price, you still keep the premium no matter what, but you will have to sell your stock, right, that you have in your account. Your stock will be sold at that higher price to the buyer, but that's not necessarily a bad thing because you get that additional capital gains on those shares, right? Because you're selling at a higher price. So not only do you get the guaranteed premium, which is very important, you're also selling at a higher price and getting capital gains. And that's when those returns and profits can look a lot healthier hitting your account, right? So, and then what do? You repeat the steps 1 through 4 again, and bring in another round of income, rinse, repeat, and repetitive cycle of generating guaranteed predictable income. Again, bread and butter strategy that you have to learn, especially when the market is going through pullbacks and potential corrections like we're seeing right now. This is a strategy that you absolutely should have in the tool belt and break it out when you need to generate that income. Now, we can't talk about cover calls without talking about some of the risk and things that you have to look out for, right? This is trading. It always comes at risk. And let's talk about some of those, right? Number 1, if the stock drops significantly, cover calls don't protect against those big losses, right? Your account's still gonna experience that drop in stock price. That value of your account's still gonna go down, but luckily you have this strategy in your toolbox that you can break out and bring in income while the stock is being sold down, right? You still have an income generating strategy to kind of offset and bring in some income into your account. Also, another risk is if the stock skyrockets past the strike price that you choose, you're going to miss out on some of those bigger gains because you do kind of cap yourself depending on the strike price that you choose. So you got to be really strategic with choosing the strike prices, right? And kind of pinpoint the prices that you want to let your stocks go for. Otherwise, you could miss out on those potential gains. And also selling too close to the money, right? I always go out of the money, just out of the money, or maybe a little bit further out of the money, but not too far. At times, I can lose out on some of that upside, right? But I'm trading that off for the guaranteed income, right? Which I'm looking for in my account. I want that guaranteed money hit in my account. So if you're selling too close to the money, that is a risk of you're limiting your upside potential in the stock. So again, just be choosy, be picky on where you want to choose those strike prices. And that way that you're not limiting yourself too much when it comes to this. Now, here's a pro tip for cover calls. You gotta sell cover calls on stocks that you're okay actually selling, right? You gotta do this strategy on stocks that you're okay actually parting ways with, right? If you don't want to part ways with this strategy, if you don't want this stock to be sold from your account, then don't do cover calls with it, because this is a trading strategy. You got to be okay with letting the shares go, right? So if this is stocks that you want to hold on to forever, then again, don't do the strategy, right? That would be my suggestion there. So that is it right there. So a quick recap: cover calls, my favorite income generating strategy, especially for this type of market when we're in a down market and a market going through a little bit of a pullback slash correction. We'll see where things are headed. This is a great strategy to implement on stocks that you already own in your account, and allows you to manage your risk while bringing in income into your account. So again, just follow these simple steps, right? Those 4 steps that I just outlined to you. You got to choose the right stock, pick the right strike price, and your expiration strategy, and you're going to be good to go. Telling you, this is an easy money strategy after that, and it works beautifully when you're implementing it correctly. So that is it. If you found this video helpful, hit that like button, hit that subscribe button, and tune in for more trading strategies, more tips with the Flex Financial Trading Group here. Drop a comment below if this video helped you out. If you got some questions on cover calls, we'd love to hear from you, or just your general feedback. We'd love to hear from you as well. Give us a little interaction. And again, stay in touch with us for our next video. Keep an eye out for that. Thanks again for tuning in, guys. Until next time, we'll see you then. Have a good one.